Hello, and welcome to the latest Expert Series webinar. Today's webinar is Smart Beta, Why Size Doesn't Matter, but Innovation Does. This is a complimentary ETF.com webinar, courtesy of Guggenheim Investments. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs, and the company behind Inside ETFs, the world's biggest ETF conference that was held late last month in Florida. Joining me today are Bill Belden. Bill is a managing director for product development at Guggenheim Investments. In his role, Bill has oversight for exchange-traded funds and target beta mutual funds. Also joining us is Michael McNiven. Michael is a managing director and a portfolio manager for Cumberland Advisors International and Global Equity Portfolio Styles. He's also an investment advisor representative for the firm, and he gets to explain all of Cumberland's investment options to individual and institutional clients alike. Before we get underway, I want you all to know that this will be available in 24 to 48 hours following today's webinar, and I also wanted to forewarn you that I will be chiming in with an occasional question. I want you all to understand there will be a Q&A at the very end, and you can answer any questions you have in the lower right of your screens. Please do so at any time. I'll certainly encourage you to do that again. The world of indexing has evolved quite a lot since the days Vanguard launched the first retail mutual fund that was indexed in the 1970s. Now, 40 years later, and nearly a generation following the launch of the first ETF in 1993, indexing is heading into a number of different directions, all of which are designed to beat the pioneering capitalization-weighted indexing methodologies pioneered by Vanguard. Whether you call it alternative beta, enhanced beta, smart beta, intelligent beta, factor-focused investment, or fundamental indexing, it is what I like to call a babble of beta, courtesy of the Wall Street marketing machine. In all, and using as liberal an interpretation of what constitutes smart beta, more than $200 billion in ETF assets are indexed in this manner in the U.S. listed universe of exchange-traded funds. To put that into perspective, that's more than 12% of the more than $1.6 trillion in total U.S. listed ETF assets. Now, whether that's low volatility, dividend weighting, a host of factor-focused strategies, or broad set-and-forget type strategies that help investors buy low and sell high, as a matter of course, this world of smart beta is growing faster and faster. Today, we'll talk about a number of smart beta strategies in exchange-traded fund wrappers, not least the Guggenheim S&P 500 Equal Weight ETF. That ETF trades under the symbol RSP. As its name suggests, it holds the stocks of the S&P 500 index, but weights them all equally and rebalances to that equal weighting every 3 months. This fund is the oldest smart beta strategy on the market and has more than $6.5 billion in assets, according to data we crunch every day here at ETF.com. More to the point, from a returns perspective, this fund has had quite a good run relative to the cap-weighted version of the S&P 500, such as SPY. Specifically, SPY has returned an annualized 9.5% over the past 10 years compared to 6.8% for SPY. Not too shabby. We'll also touch on a number of other smart beta strategies at Guggenheim. They are pure value and pure growth tilts that Guggenheim has rolled out in connection with the S&P 500, the S&P Mid-Cap 400, and the S&P Small Cap 600. In all, Guggenheim has almost $10 billion in assets. That's, of course, the $6.5 billion in RSP and almost $3 billion in all the other smart beta strategies that Guggenheim is currently marketing. So let's get right into it. Without further ado, I'd like to introduce Bill Belden of Guggenheim Partners. Bill?
Thank you, Ollie, and good afternoon to everyone who has taken time out of their day to join us this afternoon. So we appreciate you spending the time with us and look forward to an interesting conversation around smart beta. As Ali alluded to, there's a number of different terms that point to what we're seeking to capture by delivering a non-market cap weighted approach to owning the market or a specific segment of the market. So we've chosen to jump on the smart beta bandwagon, although there are several others that are probably appropriate descriptions for it as well. On this particular slide, there's a list of smart beta types of approaches that we would consider to be part of that market segment. There are others that you would add to this list, but certainly these are probably the most predominant approaches or applications of smart beta currently in the market. As you can see on the right side of the slide, it's been a dramatic growth component of the overall ETF market. You know, at $112 billion according to ETF.com statistics, it's grown to over 10% of all U.S. listed ETFs. And perhaps more importantly, it's growing at a faster pace than the remainder of the ETF market. In 2013, smart beta ETFs captured roughly 29% of equity inflows. So certainly the trend line is very favorable there, and there's certainly evidence of increasing adoption rates amongst investors. Now, we at Guggenheim like to consider ourselves, as Ali alluded to, as the first firm to offer smart beta in ETF form with the introduction of RSP, the equal-weighted S&P 500 ETF, back in 2003. And smart beta itself has continued to be an integral part of our product suite ever since, with 14 ETFs that track equal-weight indexes, another 6 that follow pure styles that Ali alluded to a moment ago, and several others that fit under the heading of smart beta. So it's near and dear to our heart, and we're pleased to enjoy the success that many of our ETFs have had in delivering attractive performance and investment results to clients. However, with the more recent proliferation of smart beta ETFs, we also believe it's incumbent on product sponsors to educate the market on what the strategies are and how they operate in pursuit of appropriately setting expectations for investors. So there's a lot of new strategies in the marketplace right now, and they're not all alike. So certainly one of the beauties of the ETF is the ability to know what you own. So while you can take a snapshot of the portfolio on any particular day, getting an understanding of what the methodology is that underlies the delivery of that portfolio is critical in making sure that investors are not surprised by what results they experience in what can be very dynamic market conditions. Now today we're going to highlight two of our approaches to delivering smart beta. Ali alluded to the equal weight approach and the pure style approach to delivering equity market exposure. So this is our pursuit of educating the market and helping you as potential investors or users of smart beta approaches to get a clear and precise understanding of exactly what they deliver and how they go about delivering it. You know, in the case of the equal weight ETFs, you know, they're pretty clear as far as, you know, how the strategy is in fact delivered, but, you know, what isn't always clear is, you know, what is the performance attribution point to as it produces outperformance through extended market cycles, and it also brings with it different risk and return dynamics that are poised to either outperform or conceivably can underperform too, depending upon what's happening in the market during any particular point in time. And so obviously equal weight ETFs are an alternative to traditional cap-weighted and actively managed core portfolios. And how they achieve the results they deliver are, as you know, Ali started to allude to, is one, through the diversification that the equal weight approach provides to investors, in contrast to a market cap-weighted approach, which results in, you know, fairly significant concentration at the higher end of the spectrum. What doesn't get as much attention as it relates to the performance delivery that equal weight ETFs provide is the fact that the rebalance frequency and the nature of it is a strong contributor from a performance attribution standpoint to the overall results. So in most of our equal weight approaches, we are rebalancing, or the index that the ETF actually seeks to track is rebalancing on a quarterly basis, and that systematic approach to adjusting weights in the portfolio to outperforming or underperforming stocks can provide enhanced risk control and obviously the opportunity to capture, you know, over the longer term outperformance within the equity market. I think it's also useful to point out at this point too is that we we get a lot of feedback as it relates to rebalancing and the costs that are associated with increased transactions that take place within the ETF. And certainly we are quick to point out that, the beauty of the ETF and the ability to transact in kind and go through rebalancing transactions on an in-kind basis affords us the ability to be pretty efficient, certainly from a tax perspective and as well from a transaction cost perspective, and in making sure that that type of portfolio management dynamic is executed in a fairly efficient manner. So again, we want to make sure that that observation that is pointed out all the time about the increased transaction activity is countered by pointing out the fact that the ETF wrapper is such an efficient delivery mechanism that it makes that impact much less consequential.
Bill, I'm sorry to interrupt you really quickly, Ollie here. Is it fair to say that the ETF is certainly a heck of a lot more efficient in this regard than, say, a mutual fund, or is it just at the margins a trivial difference there when we talk? We
would make that. Yeah, we would absolutely make that case, Ollie. I mean, I think that when you certainly, again, looking at it through the prism of two different angles, one being the tax efficiency, the ETF, I think, is proven over time that it is a superior delivery vehicle from a tax efficiency perspective, and that's largely attributable to the in-kind transactions that ETFs execute, not only on a daily basis in supporting the buying and selling activity of the fund, but also with the fund's ability to go through rebalancing activity, i.e. shifting out stocks that are no longer part of the index and taking in stocks that are part of the index can be done in a very efficient manner. And so when you do that on an in-kind basis, it's extremely cost-effective and by comparison, much more efficient than open-end mutual funds or other investment vehicles.
Okay, thank you.
Thank you. So on slide 4 here, we basically give a visual representation of using the S&P 500 as a proxy for equal weighting of the concentration that exists within that particular index. And so you can see in gray there the significant weighting that exists in the top 50 names of the S&P 500 index. And obviously, as the name implies, the equal weighting approach to delivering that same the exposure to those same names diversifies that concentration risk across all 10 deciles there. And so again, we think that this is a good visual to capture where that concentration risk actually resides. And on the right-hand side, you can see how that concentration is actually delivered in return attribution, whereas the top 50 names of the S&P 500 index using the last 3 years as an example deliver a significant portion of the total return that the index has provided, in contrast again to the equal weight approach there on the right-hand side of that graphic, which shows that a relatively small portion of the overall cumulative return has been attributable to the top 50 names in the index. So between that type of concentration, or rather diversification, I should say, and the disciplined rebalancing approach, we believe that over market cycles that equal weight can certainly add value.
Bill, this is Michael.
Yes.
I thought maybe it'd be helpful for me to give a little feedback on this because we have found that there's the major sectors or the major, I would call it, waves in the industry. And I know you're dialed down on this specific strategy, but if you think about this with any kind of longer lens, what we have going on with the smart beta approach to ETFs is what I call ETF 2.0, because the original, which was just index, full scope, cap weighted, low cost, all of that's old news, really. That's news from 10 years ago. We started our portfolios here in November of 1999 in all ETFs. And so we followed along. And the thing that I think is relevant now to this conversation is we're seeing 2.0 ETFs is where somebody comes along, does something in a consistent, repeatable way that they can offer the market a way to not have to just go full scope, full index, cap weighted, etc. And I think this is important for those who are listening on the call, because to be able to explain to somebody who says, well, gee, I can just go buy, SPY, or I can go buy whatever. Well, you can. And if you're a modern portfolio theory person, and there's certainly room for that, you go buy SPY and you go buy a couple other diversified asset classes and you go fishing. There's not a lot to do. There's not a lot to think about. But then you say, well, why do they need me as an advisor or you as an advisor? And the answer is because now we have new products to consider. And we can see, for example, RSP, which has had outperformance for 10 years. Now you can go look and say, versus the benchmark. You can look and go say, well, there are a couple times when it's underperformed, but if you look closely, it underperformed slightly in down markets. But if you have an overall up market, RSP is the better choice than SPY. And the average person, the average investor would probably not understand that. So what you have as I would say, your major ETF, RSP, is a really important development, I believe, in the history of the markets. We all know about SPY. RSP might be as revolutionary as SPY was.
Yes, well, thank you for that. And I think you touched upon a couple of points that are presented here on what is admittedly a data-heavy slide here, but we thought it was important to demonstrate, from an analytical perspective, where some of those contrasts reside in terms of the actual investment results that have occurred over the course of, roughly the past 10 years here. And so, as Ali mentioned at the outset, and you just touched upon, there is outperformance here over that particular time period, and again, admittedly captures a long-term time period, but I think it's fairly representative of other market cycles that you go through, and that, with the incremental volatility, shall we say, that comes with an equal-weighted approach, because it does have marginally incremental volatility as represented by the downside capture statistic there. That is more than offset by the return that you're getting on the upside, and as you rightly highlighted, Michael, certainly when markets are performing well, RFP does a nice job of capturing that performance, and when you look at it over a long period of time, the characteristics of that performance obviously carries through to a very attractive risk-return profile, and in contrast to mutual funds there is represented at the bottom of this particular slide here in terms of the performance. It's extremely attractive against other investment alternatives in that particular universe.
Yeah, so I would say if you are talking to a crowd of investors or people who have had, let's just say they've gone to a modern portfolio theory perspective, the first answer to come back would say, well, ultimately that's theoretical, and in application it doesn't quite follow the theories, and I'm not against the theory. But the first time you make a judgment about factor or style or anything like that, that's an active decision. It might be a latent active decision. The easiest one to make, the one that gives you the most bang for the buck, in our opinion, is equal weight. It's not the only one, as everybody knows, but it's the easiest one. That somebody who's informed on the ETF market says, pretty close, if I follow especially just the S&P 500 and I do RSP, that one judgment can bring me a couple hundred basis points outperformance on average over time. And that's useful, right? That's real returns versus some kind of static, broad-based market.
Right. And again, we've used RSP here as an example. As I mentioned a short while ago, we have 14 ETFs that fall into that equal weight heading, and they cover both market caps, sectors, and some geographical exposure too. And certainly equal weighting approaches are going to have different results depending upon the exposure that you're seeking, but the approach and the underpinnings of it, remain the same. So we would encourage people to take a look at other strategies, even just beyond RSP, which has a track record, I think, that really speaks for itself, into some other approaches in the equity market as well.
Michael, I have a question for you. At the risk of putting fly in the ointment, do the transaction costs? Bill was talking about the virtues of the ETF wrapper and how that minimizes transaction costs, associated with, say, the quarterly rebalancing on RSP. Do those transaction costs give you pause? Do you see any kind of tax consequences lurking out there for investors in an equal weight product that is rebalancing with quarterly frequency?
I don't. If you look at the space of ETF providers or what we call ETF strategists around the country, you can see that most of them have a active judgment type of approach to the way they're doing their portfolios. And as such, I don't know too many of them that specifically designate themselves as long-term capital gains only type of returns. So if you accept that as a premise that there are very few ETF strategy managers who are claiming or trying to exclusively have long-term capital gains, then the quarterly strategy of rebalancing in these equal weighted or any other type of momentum or other strategy isn't as relevant, because I don't really believe that most people are looking to an ETF strategist for a tax-sensitive long-term capital gain strategy exclusively. So as such, my answer is I don't have a problem with that. You can get some of the long-term capital gains that you want to get as a portfolio manager. You don't have to have 100% of your portfolio in some type of smart beta quarterly or monthly rebalance type of strategy. But as far as measuring it off of the industry, you're probably in fine shape, even though these are being rebalanced.
Okay, thank you.
I would say also, Ollie, just to that point, I mean, proof's in the pudding, and I'll preface this by saying, past performance is no guarantee of future results, but RSP's never delivered a long-term capital gain. So in 10-plus years of history, I think that's a pretty nice testimony to the tax efficiency of the strategy. Again, I wouldn't necessarily use that as a proxy for all smart beta at all, but certainly in the case of RSP, through the market cycles we've seen over the course of the past 10 years, still ending up with no capital gains whatsoever, long-term capital gains whatsoever, I think is a nice proof point. And I know a lot of advisors and investors had differing experiences with some of their mutual funds just over the course of this year, and they've gotten those 1099s in the past couple of weeks to evidence that.
Yeah, I'm glad you brought that up. That was that was my recollection too, that there were no cap gains. So I'm glad you brought that up. Thanks.
Yeah. If we're going to move forward now again to talk about pure style a little bit, again, this is another approach that Guggenheim has undertaken to deliver smart beta to a particular area of the market. We launched these ETFs back in early 2006. So again, another example of, by comparison, a long-term track record in contrast to some of the more recent product introductions. But what the pure style approach to delivering style investing seeks to achieve is to remove the kind of the noise, if you will, that falls in between growth and value. So one of the least recognized aspects of traditional index style investing is the degree to which overlap exists between growth and style exposures. And on this slide, you see evidence of some examples there within the S&P 500 style-based indices, which again are sub-components of or subparts of the parent index, the S&P 500, that show names that are resident in both growth and value indices and their corresponding ETFs. And so when you see there that each one of these has between 336 and 342 names in there, you're going to have 178 total holdings that are in common between the two indexes and nearly 30% of overlap. A good case in point would be J&J there at the top of the list, which represents 1.8 and 1.4% of the growth and the value indexes respectively, making it a top holding as of the beginning of this year. And so when you're seeking to have style exposure, are you seeking to have that kind of redundancy, given the challenges that, one style may have in comparison to a period of outperformance from another style? And, it's our belief that providing that style purity, again, to use that name, adds meaningful value to someone who is seeking to deliver or rather receive more exposure akin to growth or value portfolio characteristics. So on this slide here, what talks about the manner in which the pure style delivers its exposure is you start off with basically, the characteristics that are more attributable to value stocks and those correspondingly were more attributable to growth stocks, and you rank each of them, based upon those particular characteristics. and they fall within, the third that's on the value side, the third that's on the growth side, and that middle third is basically considered the blend basket, and that is not included in either one of these particular indexes. So you really do have that style purity that delivers to you as a style investor what we believe you're seeking in terms of capitalizing on the potential or opportunity for outperformance. Again, what we were talking about here is what does that noise in the middle actually bring to you? And it's our belief, as evidenced by the performance there, that you're going to be challenged to outperform if you're investing in both. Again, and to the extent you're investing one over the other, your opportunity for outperformance is going to be muted relative to something that might be a little bit more pure. So for the 1 year period that just ended at the end of December, the S&P 500 value beat the S&P 500 by 37 basis points, and growth trailed by 39 basis points, basically netting out to a push. And so, it's our belief that, what you can actually have is an investment in both pure style and pure growth and still provide the opportunity to actually outperform the parent index, the S&P 500, and that's taken place at a couple of different junctures over time, and again, deliver that type of exposure that, again, enhances the opportunity for, growth outperformance to manifest itself in your allocation, or otherwise on the value side, the same thing. And so here on slide 9, you can see the performance histories of the value and the growth indexes in contrast to the parent index, the S&P 500. And you can see through those periods in time that there have been those where both have outperformed, and certainly some, namely in the case of the growth index, some notable outperformance, which has really actually grown pretty notably over the course of just the past couple of years, as growth, has clearly been the winner of the two styles over the past 3 years. I know, Michael, you at Cumberland have also been users of pure style approaches. Maybe you could speak a little bit to the way in which your firm has looked at style and chosen to participate in some pure style exposure through time.
Well, the main thing we do, which I think if you look at our U.S. ETF model, which, as I said, we've been doing it for a long time, but if you look last year and you look at the performance of the model, we can attribute most of the performance to our portfolio, to our broad-based, we call them core judgments, which would be these type of judgments, not specific sectors or industries, but the broad-based. That's what delivered for us last year. And within that, then, we did hold some pure style. We held the pure value RPV, and that offered value on your chart. Of course, there's the growth and the value. So we look at that in our core position as seasoning. So we go through. We also held a lot last year in our core position RSP, which I would say is one of the central positions of the core, not the only. I'd say we had somewhere around 10% often in our RSP. But then if you say I have a core position that I'm running a third of the portfolio, what should I do if I have 5 to 7 ETFs that I'm selecting from broad-based approaches? What should I use? For us, the pure style approach gives us a nice, like I called it, seasoning to our core. The core was fantastic last year, and I think it's important to diversify the core. So this is diversification within broad-based ETFs, mainly relying on these type of smart beta type judgments. So we looked at the RPV and even RPG as those types that would come in as the smaller pieces of our larger core.
I was going to point out that RPV is a $550 million ETF, so liquidity probably would not be one of its problems, I suppose, if anyone wanted to critique it, I guess, right?
Yeah, I mean, that's, if you don't mind me jumping in here, one thing that's always us as an asset manager, we have a screen here. It doesn't mean it's exclusive, but our screen is 50 million. And if we see an ETF that's under 50 million, it has to be a really compelling case for why we would go and work the trade that way. There have been times when we've seen a new ETF and we went and bought it, and you have to make sure your trading desk is working the trade appropriately and having the liquidity providers and all of that. But that said, I mean, our RPV was very accessible. A lot of these smart beta strategies now have what I would call critical mass, and as such, part of the liquidity issue is no longer really a big issue. But you have to keep an eye on it.
Yeah, that's a good point, and we always make the point that when you're actually executing in any ETFs, that limit orders are a great way to go about that. We're pretty pleased with the spreads that were existing on our ETFs. We spent a lot of time on that with market makers, so we're pretty pleased with that. But I would say beyond just value, Ollie pointing out that the RPV has got over $500 million, $554 million to be more precise. The suite overall is approaching just a hair under $3 billion in total. And everyone except RFV is handily over $100 million. RFVs are just under $100 million, and so again, we believe that most of those thresholds, if you will, or minimums have been exceeded for inclusion on most platforms. So actually the Pure Style suite's been one of our fastest growing suites over the course of the past year, and again is an important part of our smart beta lineup. So. I think that what we talk about here in terms of going back to the pure style approach here is that it gives you that focused approach to style investing, because it eliminates the noise, what I characterize as the noise in overlapping exposures between growth and style, or growth and value, excuse me. What I would hasten to add is, there is a little more volatility that's associated with that as well. So similar to the equal weight analysis or attribution, you will find a little more volatility associated with a pure style approach as opposed to the traditional value and growth approaches delivered in the larger ETFs that are actually in the marketplace here. But again, over time, the risk-return profile of these strategies is extremely attractive. And for those who are style focused at all in terms of a core exposure or something that's very complementary to what otherwise might be a core exposure, we feel like there's a lot of use for a pure style to enhance results.
Yeah. Hey, Bill, I was just going to say that you rightly make the point. Anytime you make a judgment, in this case, you're making a judgment of style or equal weight or something, we're calling it smart beta. But anytime you make a judgment, by definition, if it is a real judgment, it's going to have a different volatility as opposed to the full scope, cap, weight, whatever, right? And so when you start going down the path that says, yes, I'm going to start looking for strategies that can net me outperformance versus the benchmarks by a couple percent, whatever it is, then you have made an active judgment, and as such, active judgments require a little more active monitoring. So that's why I was talking a bit earlier. If you are a person who has long-term buy, hold, rebalance approach, you wouldn't buy equal weight and pure value and treat it the same way you would buy some type of low-cost, absolute cap weight approach. You're now getting into the space of you're now a portfolio manager. You're now an investor, and so you want to keep an eye on that. You want to see when the growth would outperform the value. And so you're starting to have to monitor that more than you would just some kind of long-term perspective. But the volatility can be important because when you make that judgment, you're saying, I'm looking here because I want outperformance. And if I'm going to get outperformance, if you follow traditional theory, you've taken a slight bit more risk.
Right. And I think that that's a great point, and actually speaks to the question that we get often about equal weight or pure style, or even some of the other smart beta strategies that we have, and we get asked by are these core holdings, are they tactical or strategic holdings, and I think that's a tough one to answer because the real answer is it depends, and we would certainly make the case that there are some that are legitimate core holdings for a for a portfolio. I mean, you have to start off with what is the investment objective of the portfolio designed to achieve, and I think you're better equipped then to answer the question. But really, if you're defining core versus satellite or tactical or strategic, you're seeking kind of a risk-return profile there, and certainly we would find those that exist amongst several of these products to fit within that core holding. But as you rightly point out, sometimes with that comes a higher, or at least a different level of volatility or risk that's added to the portfolio, and you have to be aware of how that's going to impact your portfolio through different market cycles. And so, again, some are more akin to a core holding, and others, are more beneficial when taking a more tactical approach.
Yeah, absolutely right. And that's why you said it correctly. It comes down to knowing what the investment objectives are of the portfolio. And what we're talking about is degrees, because if we're comparing this off of individual stock selection type of investments of the past or even some of the present, it's a totally different game, right? We're now talking about the difference between cap weight versus equal weight versus pure style. So we're now sorting through these differences and trying to find the nuances, but relative to what it is versus some type of stock selection, it's a totally different game. So I guess what I'm trying to focus in, we're trying to show the differences here, but in fact, there are some differences and you do need to monitor them, but overall, I think the benefit of the ETF structure is in everyone's favor in this case.
Right. So I just jumped forward again to the equal weight suite just to come and list the ETFs that we have as part of the 14 ETFs that we have as part of that suite, along with a couple of the features and applications that we've been talking about on this webinar that are associated with an equal weight type of exposure. One of the points that was brought up earlier is efficiency and cost, and one thing I would be remiss to not point out would be that the equal weight suite is available on the Schwab OneSource platform, transaction-free or commission-free, I should say. And so certainly when you look at all costs associated with acquiring or transacting and owning an ETF, commissions are part of that too. So for those that have that sensitivity, be aware that you can transact in these, on a commission-free basis. But again, so this is the summary of this particular slide being the equal weight suite, and the preceding slide, which is the Pure Style Suite, two critical parts of the Guggenheim ETF product lineup that have lengthy histories associated with them. So when you go back and you look at, well, how are these products, how can I help manage my clients' expectations? How can I manage my own expectations for how these might be complementary or core parts of a portfolio construction process? You've got, between 7 and 11 years of history there to go back, and while, history isn't necessarily an indicator of future performance, it can certainly help manage expectations for different market environments. And so we would welcome to have the opportunity to follow up with participants on today's call to educate you more on these particular products and other smart beta strategies that we have at Guggenheim. And you can access us through either the website there on the page or the 188 number, Why ETFs, at the bottom of the page. Our ETF Knowledge Center is a wealth of information, and we'd welcome to have additional follow-up with you. But that's what I had prepared for today.
Yeah, Bill, I had something to add, if you don't mind.
Sure, please.
So I think it's important, people have always said, and especially Index Universe, ETF.com, and all the colleagues there have always, tried to facilitate the conversation that says when you're buying an ETF, you got to know what you're buying. And that's the argument, for the transparency of the ETF structure. And so if you follow that, you'll see that some ETFs really have very large weights of specific countries. It depends on how narrowly defined the index is that they're getting. And an example of where one of the ETFs that you have up here is RYT, which is the Equal Weight Technology ETF. Now you think about RYT versus its competitors. The competitors had Apple at a huge overweight. It's just because it's a large player in that space. And so if you open that up, looked under the hood of the ETFs that are just cap weighted, you have a very large exposure to Apple. And yet if Apple takes a swoon like it did, that ETF's going to have a hit because of that that overweight. So last year, if you were tuned into this idea and you happen to just have a traditional cap-weighted technology ETF, call it XLK or any of the competitors, and you saw that Apple was starting to have some trouble, if you were quick enough and would have thought through it, you would have known, oh, I could get rid of my Apple exposure on the downside by going to RYT. Now, you might make the case that RYT was a better place all along. That may be actually true. But at minimum, that certainly was true as one of the largest holdings in that space was going through a fairly large free fall. So that's the benefit of having these as options when you're an investor, that you can look under the hood and see what you're being exposed to.
And that goes back to that concentration slide that I had showed earlier about how heavy it can be in a top decile. I will say that the Apple example is actually, while more acutely impactful to RYT, was really the variable that determined the outperformance or underperformance for RSP itself back in
That's right.
2011 and 2012. So we had a year of slight underperformance in 2011, and through the better part of 2012, we were kind of even with the index, so it's slightly trailing it. But when Apple started to fall out of bed there in the fourth quarter, it in and of itself was the reason why RSP outperformed in 2012. So beyond just RYT, a technology index, even the S&P 500, obviously, when you get a name that big, can deliver that type of concentration risk and volatility to the portfolio. And I would be quick to point out there are some names there right now that are starting to get into the territory where valuation will be impactful, either to the benefit of or perhaps more likely to the detriment of, a broad index exposure.
Yeah, and I think it's... Oh, sorry, go ahead.
Yeah, I just had a question here. I'm going to interject, possibly oversimplicity, but sometimes just these clarifications are worthwhile. When we talk about the equal weighting strategy, it is fair to say that the portfolio, in the case of RSP, let's say, the S&P 500 portfolio, is tilted to relatively smaller holdings than the cap-weighted counterpart. And also that this methodology does afford a systematic way to sell your winners and pack up on those with relatively high expected returns, which is to say have been in a selling mode. Is that fair, those two broad generalizations about the equal weighting strategy?
I think in its most simplest form, yes.
Yeah. Okay.
Yes. And I think that if you look at the performance attribution, I think there have been a number of different empirical studies that have done the work on, providing the sources of performance. You find that it is that disciplined rebalance that adds the most value. And I say that in response to several observations that are made around, well, it's really the value and capitalization tilt that delivers the outperformance. And in reality, by comparison, that is a smaller contributor to the outperformance in contrast to the rebalancing discipline.
Okay, I'm sorry. Michael, you were just saying something when I launched into that question for Bill. Please.
Well, no, I was just going to go back to the conversation of when you have the cap-weighted index, the S&P 500 had, I think, over 6% was Apple. So as Bill was saying, yes, if you look at some outperformance versus an equal weight strategy, it was because you had Apple roaring, and at 6% of the portfolio gives you just enough oomph to outperform. But I'll give an example. It's not a U.S.-based example, but nonetheless, it goes back to the argument of saying, if I'm going to be an ETF strategist or an investor, I kind of need to know what kind of risk I'm taking. And I know that by going under the hood, if you go an equal weight strategy, you don't really have to go as much under the hood. You kind of know that there's not going to be an overrepresentation of any one name. But if you are going cap weight strategy, then you have an even greater need to know that. The example I was going to give people is EWI, which is an iShares product on Italy. If you go look under the hood there, you think you're buying Italy. In fact, you're buying 20% of ENI, which is an oil company. with its exposures mainly in North Africa. So you think you're buying Italy when in fact you're buying an oil exposure. And so, getting under the hood is always important. And the thing that I find interesting about some of these smart beta strategies, particularly the equal weight, is some of that surprise is taken away because the systematic approach of equal weight is eliminating those type of surprises.
Thank you, Michael. Are we ready to launch into Q&A, or is there anything more that Michael or Bill you have to add?
I'm ready.
Okay. I'm ready too.
All right, brace yourself. This is going to be put on your seatbelts. No, I'm joking. I'm going to start with just a little bit of maybe playful snark, but I think there's some substance to it. We talk about smart beta. I'm fond of saying the babble of beta. Everybody has their term for this. It can mean a lot of things, more than $200 billion in U.S. listed ETF assets associated with this trend. Okay, let's say we call it smart beta. Does that imply, Bill, in some sense that there's dumb beta out there, that there's stuff you want to avoid like the plague?
The answer to that is probably yes, there is, but I would characterize market cap weighted strategies as dumb beta at all, and I think that is the weakness in the use of that smart beta term, is that it infers that market cap weighting has no purpose or is deficient. Because again, market cap weighting gives a risk-return profile. It gives investment results that can be, helpful through a portfolio construction process. And because it's been the default or the standard over such a time, and I think it's achieved a position in the marketplace where it's been the go-to way to capture market exposure. And we believe that there are better ways to do it depending upon what the expectations are. But I don't believe that. I don't believe that market cap weighting certainly is dumb beta at all, although, again, I think the jury may still be out on some other approaches to capturing exposure that are more recently launched, and results will speak for themselves over time.
Okay. I want to circle to you, Michael, and ask the same question just through a slightly different lens of a practitioner. But first, I just want to remind our audience that you're free to ask any questions, and you can do so at the lower right of your windows there. So please chime in. We have a few coming in, and they're starting to accelerate, but by all means, weigh in. Michael, just to reframe the question I just asked Bill, you talked during some of your comments earlier about ETF 2.0. I believe you were, in a general sense, extolling the virtues of the smart beta movement. And yet there are some cap-weighted people who have an investment in this whole juggernaut, which is still, as we know, very substantial, who believe that you can get your alpha, let's say you can get your smart beta through pure beta, which is to say with a cap-weighted approach, you could actually put together a portfolio that will give you outperformance relative to a very broad indexing approach. Do you have any opinions about that? Are you skeptical? Do you think that's possible?
No. I mean, it's partly what we do, right? We're not investing 100% in smart beta, and we've been investing in cap-weight ETFs since 1999. So, if the moment we didn't think that we could add some alpha as a strategist, we don't deserve to be in the business. So I think that the smart beta, which I was extolling the virtues, simply I think it's different. It's new. It shows an active, consistent, repeatable approach to market investing, and pay attention to it. It's something that you can offer as a person familiar with the space that's valuable. I was going to tell you, there's the flip side. We're talking about smart beta. It could also be called dumb alpha. So, it can go two ways. It reminds me, and if you've heard this joke before, it reminds me of the venerable professor and his student walking across the lawn of the great university, and he's pontificating about all the great theories of market efficiency and all of that. And the student says, "Hey, professor, there's a $5 bill." And the professor doesn't stop. He doesn't look down. He keeps walking. He says, "That's impossible, because if there was, somebody would have picked it up already." And that's the difference, right? People have different approaches. And this approach that says the student doesn't care about the theory picks up the $5, right? And so depending on what your perspective is, we'll see how you approach the market. I think there's certainly place for smart beta. I think there's a place for innovation in this space. And I also think there's a place for what we would just call the traditional cap-weighted, full-scope, index, low-cost. That has its place. And it just comes down to what Bill said earlier, and that is, what's the portfolio objective, what is the investment objective, and the need of the client?
Ali, I would jump in just on that question too, and taking it back to Michael's observation. We use that 1.0, 2.0 observation a lot ourselves, and equal weight was perhaps the leading edge of 2.0, and whether or not we're at 3.0 or 3.5 is anybody's assessment at this particular point in time. But there is room for innovation, and we think that there will continue to be opportunities to capture certain exposures in different ways that can be additive to investors in trying to put together portfolios. And so I think that the more interesting time or more interesting argument perhaps over time will be making the case for whether one strategy should be a significant core part of a portfolio allocation, i.e. the one you build around, or the one that you add to the core to add a certain tilt based upon a particular market outlook.
Right. It's interesting. We have a comment, if not a question, from the audience, which I will share because I think it's germane to what we're talking about here, that smart beta was coined by Towers Watson in London, and the meaning was that you need to be smart about how you choose your beta, and you need to study all your beta options, and it has nothing to do with cap weighting. We're implying that it is dumb. It's just a silly criticism from fans of cap weighting. I think that's an interesting observation there. There's a finer... Go ahead, Michael.
Ollie, just let me say very quickly. I mean, the answer is, as you have many more investors continue to discover the ETF structure, you're going to have many people who have a very active approach, maybe come from a stock picking background or something like that. And they may not be interested in traditional cap weight, low cost ETFs. But some type of collection of, we're calling it smart beta, that might be appealing to them. So that's going to draw in the next wave of people who may have not previously been involved in the ETF business. So I think it attracts these different variations and permutations, attract different investors, all adding to the overall growth of the space.
Right. Bill, I wanted to ask you, Michael was saying, stuff about what they do at Cumberland to try to add alpha to their clients' portfolios. Help the attendees sort of situate how these smart beta products would fit into an overall portfolio. I mean, there are some people who say you should go for a broad sort of S&P 500 alternative, or Russell 1000, or whatever the broad swath of the market is, and do it with a smart beta screen. Say what Research Affiliate serves up, or even First Trust with AlphaDeck, something really huge. Or there's some people who say you pick your spots, which is kind of what Michael was saying. You got to do your due diligence. How would you frame it from a fund sponsor perspective, Bill?
I would go back maybe to an earlier comment that I was making before, and again, I don't mean to deflect the question, but you got to start with what you're seeking to achieve here, right? So if you're just going to look at, okay, I'm going to look at the most conservative to the most aggressive spectrum, and and everywhere in between, well, pick a spot. And then I think you're better equipped to answer that question. If you were going to take the average investor seeking to get results over time, then they're going to have a portfolio allocation that's going to differ from someone who's in retirement and has, higher income needs, who may be more akin to, hey, I want to go with something that is based more overtly around, dividends, as I think you alluded to earlier, because I have an income need, and, oh, by the way, the strategy touts its ability to deliver total return in excess of broad market benchmarks over time. And so I think that, again, the argument that we make is that even with our own strategies, again, like RSP, and RSP, we make the case that it is a core holding. It delivers the, investment results that, we showed earlier in the webinar, and we think that those stack up pretty well against other competing core alternatives, if you will. But we would quickly add that, the periods of outperformance that RSP has delivered have been primarily achieved in rising markets, and that if you want to use it as a performance enhancer, then that would be the type of environment, depending upon your outlook, where it can be additive. And, I think that that's somewhat consistent across the equal weight spectrum. And I would quickly add that, the same should be said of pure style, and that when, faster growing companies with growth characteristics are, outperforming, then if you want to take advantage of that, then a pure growth approach can deliver that to you. But you really have to start on, the starting line is always, what are you trying to achieve? And then let's put it together. And so a lot of our education as an ETF sponsor around these particular strategies starts with a dialogue about, these are the environments in which this strategy is designed to outperform, and these are the type of portfolios where it can definitely add value.
Right. Now, you have decent assets in all of these. You have 14, right, in the equal-weighted suite. Is that correct, Bill?
We do, right. We have 14 in the equal-weighted suite.
One of them sticks out like a sore thumb in terms of relatively low assets. And I wanted to ask you a question in connection with that. The Guggenheim MSCI Emerging Markets Equal Weight ETF, trading under the symbol EWEM, less than $10 million in assets. That certainly poses some liquidity issues. And I'm wondering if you might comment on, is there a difficulty in making this pitch in a relatively illiquid space like the emerging markets, where this quarterly rebalancing or the rebalancing per se would pose a different kind of a problem than, say, RSP, which is traveling in some of the most liquid stocks on the planet?
Yeah, I would try to get you off of that liquidity issue. I think that, in emerging markets, it does present a different set of challenges, more based upon the types of securities that are in the index and the countries in which those securities reside. So I don't know that it's as much on the liquidity side as it would be more the specific performance attributes of actually having an equal weighting approach in EM. And as you know, we've been in a pretty challenging market environment for emerging markets over the course of the past couple of years. And so, it really hasn't had the opportunity to show what it can do, I think in contrast to the broader MSCI Emerging Markets Index. But we still believe that the tenets that contribute to equal weights outperformance over time remain applicable in the case of the emerging markets and EWEM. They just haven't evidenced themselves yet, given the market environment that we've been in. But it is not, I would encourage people not to attribute that primarily, if at all, to liquidity constraints.
Got it. Michael, I wanted to ask a final question. We're nearing the end of our webinar here. But there's been a lot of focus on a lot of factor-focused smart beta, dividend strategies, low volatility, small caps, all kinds of tilts that can give you outsized returns. And there's been concern, particularly with regards to dividends, that too much of a good thing may be bad. That these factors are going to, if you go to the well too much, it just won't produce any water anymore. And I'm wondering, what are the risks from a practitioner's point of view of managing this? I mean, is it a real risk that dividend-weighted strategies are going to be relatively less perspective going forward if everybody and their brother is piling into them? And what do you do? What do you look for? How do you manage this phenomenon?
Well, I mean, it's a good question, and that question's never going to go away, right? If too many people employ a strategy, does it take away the essential value of the strategy? And I think the theory says, yeah, if too many people are involved in it, maybe on the margin at a minimum, the attractiveness of that idea is less. The only thing you can do is really be monitoring the supply and demand, not only of the securities that it holds, but the securities themselves. And so if you see a space that becomes crowded, you have to start paying attention to liquidity within the space, within the securities. You have to start really tracking which ones are gaining traction, which ones are not gaining traction, and why. If you come to a judgment that it's because it's no longer a good idea in general, then of course it doesn't matter. If you come to the conclusion it's still a good idea, but we just have to get under the hood and start figuring out why certain ones are getting more traction, that's part of your adventure as a portfolio manager.
All right, thanks. So that's about all the time we have. That concludes our Expert Series webinar, Smart Beta, Why Size Doesn't Matter, but Innovation Does. Bill and Michael, I want to thank you for being my guests, and I want to thank the audience for attending and for submitting questions. Again, as I said earlier, the presentation will be available to all of you in 24 to 48 hours. and you'll receive instructions on how to obtain the presentation in an email. On that note, on behalf of Bill and Michael, my guests from Guggenheim and Cumberland Advisors, as well as my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.